Hello and welcome to this special broadcast on the minutes of the last Monetary Policy Committee meeting that took place earlier this month on February 8th. The key highlights of the meeting are more or less predictable. We see the 3 RBI members and 1 external member, Shashanka Bhide, largely worried about core inflation persisting above the 6% mark. The Governor, Shaktikanta Das, is very clearly pointing out that the fall in inflation that we saw in November and more importantly in December was largely because of vegetables, which could be passing, and the one that persists, core inflation, is sticky. Rajiv Ranjan, the other RBI member, says intermittent inflation is lower, but steady inflation, which is core inflation, remains high, and therefore to bring it back to the MPC's given target, they will have to persist with the rate hike. That's how they support the rate hike. The 2 of them who have voted against the rate hike and have asked for a change in the policy stance, Dr. Ashima Goyal and Dr. Jayanth Varma, point out that inflation has been coming down. In fact, is lower than what the RBI forecast. They are at pains to point out that if there is over front loading of rate hikes, as Ashima Goyal calls it, the chances are that growth, which is still incipient, may be hurt. Dr. Varma basically saying that he has already made his comment in the previous policy statement, merely states that RBI erred on the side of slowly raising rates when inflation was rising. Now it is probably erring on the side of raising rates too much and hurting growth. That's the sum and substance, but we have the external members themselves joining us, so let us hear it from them. Joining me now are Dr. Jayanth Varma, Dr. Shashanka Bhide and Dr. Ashima Goyal. Gentlemen, and Ashima, thank you very much for joining us. Ashima, if I can start with you. You argue very cogently, emphatically, that inflation has been coming down. But the latest reading would make you change your mind. It's indicating otherwise.
I argued that some parts of core inflation are coming down, but I said that the headline inflation that decreased was due to could be transient volatile vegetable prices. Yeah, so yes. I agree with Rajiv Ranjan that I call it transient.
Okay.
You know, as monetary policy members, we have to look through transient inflation spike. Current spike in the latest spike which we have seen is also one of those transient spikes.
Okay.
But over the longer term, I think that firms, when they see overall some international prices have softened, some input costs have softened, and as demand is softening, we've seen that in the latest import data also, they will not be able to price on costs as aggressively. Yeah. So we should, and WPI inflation has really fallen, which captures firm prices more and their costs. Yeah. So those are the factors that I see decreasing inflation, as well as the real repo rate is positive because spreads are high, loan rates are positive, and demand is very interest sensitive in India because of the large young people buying goods on credit, housing loans being large now. So all this are factors reducing demand, and we should let this play out. This will act to damp core inflation.
Okay.
You don't need to keep raising rates if inflation is high. Okay. If you already raised them, you wait and see their effects. No?
Okay. Well, the argument against that, and this one is to Dr. Varma. Dr. Varma, you know, at 6.5% inflation in January, the chances are it's going to be another 6.4 in February as well. The MPC is way off target. It's not even within the tolerance band, way off target. Would that want you to reconsider your stance?
No, you see, I think the way I look at it is that, monetary policy cannot be fighting yesterday's battles and today's battles, because of the lags that are there in how monetary policy impacts the economy. You are always fighting tomorrow's battles and not today's battles. So month by month, the rate goes up, goes down. But the point is that we have done a significant amount of tightening over the last 8-9 months, and that has pushed the policy rate to a point where it is having an impact on the economy. It is destroying demand, and that demand destruction will feed through into a moderation of inflation. That's going to happen. And when you take that forward-looking perspective, then what you're really looking at is that we have done a great deal of tightening. That tightening is beginning to have an impact on the economy, and more will happen in the months ahead. And when you take that forward perspective, then what you're really looking at is that the concerns are more about growth than about inflation. There are a whole lot of structural factors that are driving the inflation down. An important element is crude. Crude has remained far below the RBI projections for many months now, and those have not been fed through into retail prices. In fact, even looking at Brent crude is a significant overestimate, because about 25 to 30% of our crude is basically coming from Russia, which is probably costing us $60 a barrel. And therefore, there is a huge amount of pass-through of the crude reduction. If the weighted average price of crude today is probably 75, and there is an enormous amount of pass-through that can happen to retail prices in the months ahead, because all those projections that we are seeing are based on 95. So there is a huge amount of pass-through that is possible, but has to happen in the months ahead, because the backlog of under-recovery will go away, and the oil companies would be flush with funds today. They're minting money at these, $60 crude prices from the Urals. That passes through, and we're going to see a very substantial decline in inflation. At the same time, where growth is going to be is going to remain fragile. That is my variant.
So are you asking for a cut in excise duties? Because the so-called $60 Ural crude hasn't flowed down to the consumer level. So are you, like Ashima Goyal, very upfront is asking for a cut in excise duties? Is that your ask, sir?
No, what I'm saying is that there is a pass-through that has to happen, right? If our weighted average price of crude is far below what it was a few months ago, then the retail price must follow, right? Retail prices follow global prices of crude with a lag. They followed with a lag when the crude went up, and they will follow with a lag when crude goes down. I'm not asking for anything. I'm simply saying
but you're saying it will come down.
In the logical course that has to happen, that when crude is costing us so low, then our pump prices cannot remain so high. There will be a pass-through that will happen, and there is an accumulated pass-through on the negative side now.
Well, actually, crude was at 121 only 1 year ago when the war broke out, barely for a month. It has fallen thereafter, but our core inflation refuses to fall. So I'll come to that point again. The supposed falling of crude-related and energy-related prices is not happening in the economy. Dr. Bhide, to come to you, what's your assessment now? On hindsight, do you think that it was just as well that Reserve Bank went with the rate hike? What's your, forecast in terms of forthcoming inflation readings, since one of them is way higher than what Reserve Bank itself forecast? Reserve Bank cut the Q4 from 5.9 to 5.7. Now it looks set to be 6%, the Q4 inflation. So anything further you would like to add?
See, I think the issue really is with core inflation, because I guess the fluctuations that we saw in November, December, and probably also now in January are a few commodities, I think, which are causing these large changes. And therefore, the projections, in terms of projections, I think what is important is that the core inflation has to show moderation well below 6%. So I think the projections for the year for 23-24 are obviously below 6%, but I think that is also because of the reduction and across the board, I think expected reduction in the price increases. So I think the January figures are also not reflecting the sharp increase in prices across the board. We see large increases, I think, in wheat and so on. So,
Yes.
I think the concern is that it is important to see that there is a moderation in price pressures in most of the commodities that we see.
Yeah, actually, the cereals inflation was what I was going to toss to the other members as well. Ashima, since the Monetary Policy Committee met on Feb 8, we know that the cereals inflation is up 16.2% year on year and about 2.5% January over December. We are also, in the past few days, getting data that the early onset of heat will probably reduce the wheat crop, and therefore the expected sobering of cereals prices perhaps may not happen. Your thoughts on food inflation itself?
Right. I have said that our action has to be data-based. So if all these fears materialize and wheat prices rise, there's a heat effect, and there is government action, there's sale from FCI, and the expected effect of a good winter harvest does not happen, and we think that this is going to have persistent effects on our projection, then our rates will be adjusted suitably. So our action will be data dependent. But at present, the forecasts are showing that 1 year ahead inflation is much less than 6. And our repo rate is 6.5. So that you have a real rate of 1. This is contractionary. Just remember, we have raised rates by a large amount, nominal rates, and real rates are positive 1%. And this is contractionary for demand and will work to reduce core inflation.
Yeah, the real rates, if at 6.5 and 5.6% next fourth quarter inflation, the real rate still is only 90 basis points positive. Is there not a case? I mean, there were some RBI studies which were indicating that the real positive rate should be at least 150 basis points. I mean, there was, of course, disagreement about it. But, I mean, there have been many periods in the past when positive real rate is more than 100 basis points.
But those were rates when growth slowed dramatically, when the real repo rate went to 4 and 5% at a highly negative effect. And just remember that we are looking at a growth slowdown. Exports have slowed. There has been fiscal consolidation that reduces government demand. And other such and the effect of, as I said, interest elastic demand because of the real repo rate being positive. So therefore, there is going to be some effect on inflation from all this.
Okay, I have to take a mandatory break. Back in a jiffy with more questions for our experts. So this is an extremely interesting vote where 2 members have voted against both the rate hike and the stance. We are back. The Monetary Policy Committee's minutes are out, and as we knew before, 2 members have voted against the rate hike and 4 members support the rate hike. All the 3 RBI members support the rate hike. External member Dr. Shashanka Bhide also supported the rate hike, and members Ashima Goyal and Jayanth Varma voted against it. We are speaking to the external members, Dr. Goyal, Varma and Dr. Bhide. Gentlemen and Ashima, thank you for waiting by. Dr. Varma, the mandate is to keep it below 6%, and you're likely to be violating the mandate for yet another quarter, which is the current one. And that is the primary mandate of the MPC. Growth is a subsidiary mandate. Will that make you want to change your mind?
You see, I have written in my statements that the high inflation that we are seeing today is the result of mistakes that were made in, in 21-22. Okay? Now, there is no point in, saying, compensating for that by making the opposite mistakes today. Monetary policy cannot and should not be guilt-driven. The fact that you made a mistake a year ago is not a reason for you to make an opposite mistake today. We know that nothing that we do today, raising the rate by 25 basis points in earlier this month, would not do anything to February inflation, will not do anything to March inflation. Those numbers are there. Those numbers are not going to be changed by what we're doing now. These are things that are going back very, very long, many 3, 4, 5 quarters past. And there's nothing we can do about it today. We have to look forward.
But Dr. Varma, looking forward as well, the Reserve Bank's forecast is 5.6% a year ahead, which is barely within the tolerance band, barely within 6%. The target is 4%. So does one not have to do more to get there?
Yeah, the RBI forecast is based on crude at $95 a barrel, right? Now, when was crude actually trading at 95 last?
I take your point, sir.
I have forgotten.
I take your point.
I have forgotten when crude traded at 95.
No, I take your point, sir.
The
Reserve Bank.
No,
1 minute, sir. So 1 minute.
Still not gone to anywhere near.
Yeah, I agree. But RBI's forecast or RBI's assumption of crude was at $100 even when they were forecasting 5.7 for the current quarter. But in spite of that higher assumption they made, look at the current inflation. It's way above what they forecast. So just by sticking to that $95, we aren't necessarily proving that inflation is going to be lower than the Reserve Bank's forecast. It might well be higher as it is in the current quarter, can't it?
Well, so 5.7 is assuming that pass-through from lower crude prices will not happen for the next 3, 4, 5 quarters. I mean, if that is the assumption, then true, then you got to raise rates a lot. If you believe that when world crude is trading at 85, when India is buying crude at 75, crude is going to cost us $95 for the foreseeable future, then yes, rates will have to go much higher, then the rates will have to go up significantly. Yes, there's no question about that. But I do not believe that it is reasonable to assume that our crude pump prices will remain at the same level 3 quarters from today when our crude is costing us so much less.
Okay. Well, it's actually only crude that seems to have come down even today when generally risk assets are lower, metal prices are still high. So there is a persistence of core elsewhere as well. But I'll come back to that point. Let me ask Dr. Bhide. Sir, the fact that the current inflation is, the current quarter is much higher than what the Reserve Bank forecast. The Reserve Bank forecast 5.7. It now looks like we're going to end this quarter a little closer to 6. A second point, there is likelihood of higher serial inflation. So all this, is it giving you the feeling that the Reserve Bank will be forced to push up its forecasts for some parts of FY24?
So I guess what has happened in the Q4 is the January numbers now. And as you said, what happens to the Rabi harvest and so on, I guess will influence, I think, the prices in the next couple of months also. But I think, so the forecast projections for 23-24, are based on assuming a normal monsoon and the, crude, what it is, and the exchange rate and so on. So there is, I think it is important to sort of say that the trajectories of both growth and inflation, projections of those trajectories are subject to considerable uncertainty, I think. And so
at the moment, sir, in the near term, is there an upward bias to the forecasts for both these reasons? That Jan inflation is higher, the Rabi crop seems to be under a bit of duress because of early and more intense heat. And let's not forget, even the US inflation numbers are coming in higher than estimates, both CPI and PPI. For a combination, would you fear that there is an upward bias to the near-term readings?
I mean, upward bias or the possibility of inflation rate being higher.
Higher than expected. That's what I meant.
Yeah.
Do you think there is a fear?
Yeah, I think there is certainly a risk attached to that trajectory, and I think for the reasons that you mentioned for food inflation particularly, I mean there is this possibility of food inflation being higher than I think what we probably assume in making that forecast for the fourth quarter. So I think so in these assessments, what is also assumed is that the pass through of higher commodity prices that we saw earlier and the higher energy prices and so on that pass through would be complete, and therefore the core inflation should reduce over time. And I think that is also assuming that there are no additional exogenous shocks to this. And therefore, I think the reason to be cautious at this particular point is that we need to make sure that the moderation in inflation is sort of wider than what we have seen so far.
Okay. All right. I'm sorry we're out of time, but it was a pleasure speaking to all three of you, Dr. Bhide, Dr. Varma and Dr. Goyal. Thank you very much for joining us. The two external members pretty firm that the front loading is done with, and now we may be hurting growth. It's time to pause. But Dr. Bhide, as he has written, still worrying that at least in the near term, there are a combination of factors that could push inflation higher. We wind up this special broadcast on the minutes of the Monetary Policy Committee meeting. Keep it with CNBC-TV18. More news and updates are lined up for you.
MCX Zinc Mini Futures Contract 1 Metric